Imagine you're staring at an invoice, same oil, same barrels, same destination. But one line is different, the currency, not dollars. You blink, you read it again, still not dollars. Nothing explodes, no alarms, no emergency summit on live TV. Just a quiet change in a spreadsheet. But here's the twist. That invoice isn't just a bill, it's a rule book. For 50 years, the world didn't just buy oil, it rented the dollar. Every tanker reinforced it, every payment fed it, every deal said the same thing without saying it out loud. This is the price of energy, and this is the price of entry. Now imagine that rule changing. Not loudly, not dramatically, just calmly. Because the most dangerous shifts in finance don't look like revolutions. They look like paperwork, and by the time anyone notices, the system is already leaning. Let me be clear. This is not a story about the dollar collapsing tomorrow morning. No countdown, no dramatic cliff. If that's what you're here for, you're early. Very early. This story is about something quieter and far more durable. Power. Not the kind with tanks, the kind with invoices. Because here's the uncomfortable truth. Currencies don't dominate the world because people like them. They dominate because people need them. The dollar isn't powerful because it's trusted in some moral sense. It's powerful because entire systems are built so that opting out is expensive. Sometimes impossible. Think of it like a highway system. You don't love the highway. You don't wake up grateful for it. But if every road leads there, you drive on it anyway. That's currency power. It's enforced without soldiers, without speeches, without declarations. It's enforced through contracts, clearing systems, benchmarks, habits stacked on top of habits. By the time you notice, you're already inside. And once you're inside, questioning the rules doesn't look heroic. It looks risky. This is why most challenges to the dollar don't fail loudly. They dissolve quietly. Not because someone says no, but because the cost of yes is too high. So when people ask, what if oil stops being sold in dollars? They're asking the wrong question. The real question is this. What happens when a system built on requirement slowly stops being required? Not rejected, not overthrown, just bypassed. Because when power is embedded in infrastructure, change doesn't come as a revolution. It comes as rerouting. And that's what this story is really about. Not collapse, but control. To understand how oil ended up priced in dollars, you have to rewind to a moment when the rules were already breaking. The early 1970s. The gold standard was gone. Quietly. Abruptly. One day, dollars could be exchanged for gold. The next day, they couldn't. No referendum, no global vote. Just a televised announcement and a new reality. And suddenly, the dollar had a problem. It was still everywhere, but it was no longer anchored to anything solid. At the same time, another problem was brewing. Oil. Energy prices were rising. Oil exporting countries were sitting on massive surpluses, and the world needed a way to keep trade flowing without blowing itself apart. This is where the story usually turns dramatic. Secret plots, master plans, evil geniuses. That's not what happened. What happened was far more boring and far more effective. Oil exporters asked a simple question. What do we do with the money? They needed a place to park it, a place deep enough to absorb it, liquid enough to move it, safe enough to trust it. There weren't many options, so the deal formed, not all at once, not on paper with a villain's signature. Oil would be priced in dollars, not because of loyalty, not because of ideology, because it made the math easier, and in return, those dollars would flow back into US assets, into government debt, into a financial system big enough to handle the scale. Stability in exchange for currency obedience. No speeches, no flags, just alignment of interests. Oil in dollars meant every country that needed energy needed dollars first. And just like that, The dollar stopped being just a currency. It became the entry ticket. Now, here's where the system locks itself in. Think of the global economy as a machine, not a battlefield. At the center of it is something I'll call the dollar flywheel. It works like this. Oil is priced in dollars, so importers need dollars. That creates constant global demand. Those dollars don't disappear. They accumulate. Where do they go? Into US financial markets, treasury bonds, dollar-denominated assets. That money helps finance US deficits, which keeps markets deep, liquid, reliable, and then the cycle completes. Oil exporters invest those dollars, earn returns, reinforce the system that made the dollars valuable in the first place. Round and round it goes. No single push keeps it spinning. Momentum does. This is why the system is so hard to challenge. There's no villain to overthrow, no lever to pull, just incentives stacked so tightly that opting out feels like self-harm. Even countries that dislike the system use it. Even rivals finance it. Because once a flywheel is spinning fast enough, stopping it isn't about strength, it's about friction. And global finance is very good at reducing friction. This is why morality doesn't matter here. Intentions don't matter. The machine doesn't care who you are or what you believe. It only cares that the inputs keep coming. And for decades, they did. When people talk about the petrodollar, they usually talk about status, prestige, influence, symbolism. That misses the point. The real benefit isn't psychological, it's mechanical. Because when oil is priced in dollars, the rest of the world has to hold them. Not occasionally, constantly. That creates something no other country gets. Permanent external demand for its currency. And that changes everything. For the United States, borrowing becomes cheap, not free, but easier than it should be. When Washington runs deficits, the world absorbs them. Treasury bonds don't have to beg for buyers, they attract them. Not because the US is flawless, but because the system requires dollars before it allows trade. This is why the US can import more than it exports year after year without facing immediate punishment. Most countries try that, their currency collapses. America's doesn't. Now zoom in. Picture an American consumer standing in a store, buying a phone assembled overseas or clothes made an ocean away. The price feels normal, affordable, almost boring. That's not productivity magic, that's currency gravity. The dollar floats higher than it should, so imports feel cheaper, inflation arrives slower. Trade deficits feel painless. This is what Arab oil actually buys the US time. Flexibility and the luxury of delay. The bill still exists, it's just deferred. Now here's where the story shifts. Because systems like this don't collapse, they fray. And they don't fray with announcements, they fray with exceptions. Here's the catch. Arab countries don't need to declare war on the dollar to weaken its grip. They just need alternatives. Small ones. A bilateral deal here. A different settlement currency there. A partial payment that never touches New York. None of this breaks the system. At first, it just reduces dependence. A little less dollar exposure. A little more optionality. And that's enough to matter, because currency power isn't binary, it's cumulative. Each non-dollar transaction is invisible on its own, but together they change behavior. New clearing systems, new benchmarks, new habits. Not replacing the dollar, working around it. Here's the catch again. This doesn't show up as a headline. It shows up as a footnote, a contract clause, a settlement choice. A line item accountants barely notice. No speeches, no flags, just paperwork. And by the time the pattern is visible, the system has already adapted. Not collapsed, adapted. That's how power really erodes, not when someone shouts no, but when they quietly stop asking permission. This is where the story usually goes wrong, Because the moment people imagine the dollar losing ground, they immediately reach for a replacement, the yuan, the euro, something new, something clean, a new king. That's a fantasy. There is no heroic challenger waiting backstage. What comes next isn't replacement, it's fragmentation. A world where no single currency sits at the center, just pieces, regional currencies for regional trade, bilateral deals between countries that trust each other more than markets, currency baskets that shift with politics, hedging layered on top of hedging. I call it the currency shrapnel world. Many pieces, no center, messy, inefficient, harder to ensure. And that's the key point. The dollar's power doesn't come from perfection. It comes from coordination. Everyone uses it because everyone else does. Break that coordination and you don't get a new order. You get friction, higher transaction costs, more volatility, more risk priced into everything. This is why the yuan takes over, makes great thumbnails and terrible analysis. China doesn't want to absorb the world's liquidity. Europe can't agree with itself long enough to run a global currency. No one wants the burden that comes with dominance. Because reserve currencies don't just receive power, they absorb stress. And in a fragmented world, that stress doesn't disappear. It spreads. So let's say oil pricing starts to shift. Not everywhere, not all at once. What breaks? Not the dollar, not immediately. What breaks first is comfort. Here's what stress looks like. Borrowing costs creep up, not explode. Creep. Investors demand slightly higher returns because certainty has a price, and it just went up. US assets get repriced, not dumped, re-evaluated. Now zoom out. A Gulf sovereign wealth fund looks at its portfolio. Mostly dollar assets, mostly treasuries. Nothing is wrong. But something feels exposed, so they rebalance, slowly. Less concentration, more diversification. That's not panic, that's risk management. Now zoom in again. Months later, a US homeowner refinances a mortgage. The rate is higher than expected. Not shocking, just annoying. No one mentions oil, no one mentions Saudi Arabia, no one mentions currencies, but the chain is there. Macro stress doesn't arrive with a label. It arrives disguised as market conditions. This is how systems respond to pressure, not with collapse, with adjustment, volatility before catastrophe. If catastrophe comes at all, and most of the time it doesn't. What you get instead is a world that feels tighter, less forgiving, more expensive, not broken, just less easy. And that's usually how power fades, not in flames, but in friction. At this point, the obvious question is simple. If the system is imperfect, if alternatives exist, if dependence carries risk, why hasn't it changed already? The answer is uncomfortable, but it's not sinister, because the dollar still works. It's liquid in a way no other currency is, deep enough to absorb shocks, familiar enough to trust under stress. When markets panic, money doesn't run from the dollar, it runs to it. Arab oil exporters understand this better than most. They manage enormous surpluses. They need places to park them without moving prices against themselves. There are very few places in the world that can handle that scale. Then there's security. Not just military guarantees, but financial ones. Clearing systems, legal frameworks, enforcement that works the same on good days and bad. And finally, there's fear. Not fear of Washington, fear of chaos. Because breaking a system that still functions is riskier than staying inside it, especially when you hold large amounts of dollar assets already. Weakening the dollar too fast would hurt them first, so they move carefully, incrementally, with optionality. This isn't submission, it's risk management, and it's exactly how rational actors behave inside imperfect systems. Here's where the internet gets dramatic. Collapse timelines, countdowns, predictions with dates attached. They all miss the same point. Currencies don't die in explosions. They decay. Now do the math. The British pound didn't disappear when Britain lost dominance. It didn't vanish after the war. It didn't implode overnight. It slowly stopped being central. Less trade, fewer reserves, reduced influence, still used, just no longer decisive. That's how monetary power fades. Gradually enough that people deny it. Then suddenly enough that people notice. Even if oil pricing diversified tomorrow, the dollar wouldn't collapse. It would adjust. Markets would adapt. Institutions would reprice risk. The world wouldn't end. It would get more complex, more fragmented, more expensive to coordinate, and that's what scares policymakers more than collapse. Because chaos isn't dramatic, it's exhausting. So when you hear someone promise an instant end to the dollar, pause. This isn't a movie, it's a balance sheet. And balance sheets don't explode, they erode. If you're still here, congratulations. You've just spent several minutes watching a financial myth not explode, but slowly bleed out. If this is your idea of entertainment, you might be in the right place, so go ahead. Subscribe or don't. Either way, the system will keep running. But if you enjoy understanding why it runs the way it does and watching simple narratives fail under pressure, you know what to do. At this point, the story usually splits into camps. The East wins, the West loses. Someone celebrates. That's not how this works. A post-dollar oil world doesn't hand victory to regions. It rewards agility. The real winners aren't countries with resources. They're countries with plumbing, settlement systems, clearing mechanisms, legal frameworks that work across borders, because oil is easy to sell. Settling the transaction is the hard part. In a fragmented currency world, the power shifts to whoever can move value quickly, cheaply, and predictably. Banks that can clear multiple currencies without friction. Exchanges that can hedge risk across regions. Institutions that can price complexity instead of avoiding it. That's where leverage lives. Not in the barrel. In the back end. This is why some small states punch above their weight. They don't dominate production. They dominate intermediation. They become neutral ground. Financial Switzerland, but for energy flows. And in that world, ideology matters less than uptime. The winners aren't the loudest. They're the most boring. The ones whose systems don't crash when everyone else hesitates. Because in global finance, power doesn't belong to who owns the resource. It belongs to who controls the switch. The real risk here isn't collapse. It's effort. For decades, the United States has lived in a financial environment where capital arrived by default. Not because it was chased, because it was expected. That's the privilege of being the center of gravity. But imagine gravity with friction, still strong, still pulling, just no longer effortless. In a world where oil pricing slowly diversifies, the US doesn't lose dominance overnight, it loses complacency. Borrowing still works, markets still function, the dollar still matters. But assumptions start to crack. Treasuries have to compete a little harder. Investors ask more questions. Returns have to justify risk instead of hiding behind habit. That's not a crisis. It's a constraint. And constraints change behavior. Policy becomes more disciplined. Deficits feel heavier. Trade-offs become visible. Not because the US is weak, but because the world is less captive. This is what adjustment looks like at the top. Not humiliation, not downfall, just gravity. With friction. And for a system built on momentum, even friction matters. So where does this actually go? Not in one direction, in three, and none of them involve a clean ending. This is the boring future, which is usually the real one. The dollar stays on top. Just not alone. Oil continues to be priced mostly in dollars, but with exceptions. More side deals, more hedging, more optionality. The dollar becomes first among unequals, still dominant, still central, just less absolute. Markets adapt, institutions adjust, nothing breaks, the system bends and survives. Here's the messier path. Energy trade starts to regionalize. Different benchmarks, different currencies, different settlement rules. Asia prices energy one way, Europe another. The Middle East experiments somewhere in between. Coordination costs rise. Volatility becomes normal. Not because anyone planned chaos, but because fragmentation has a price. Oil still flows. Trade still happens. It's just more expensive to make the math work. This is the scenario everyone argues about. A shock hits. Not necessarily oil-related. A financial crisis. A geopolitical rupture. A sudden loss of trust. Oil pricing doesn't cause the break. It amplifies it. Existing diversification becomes an escape route. What was optional becomes necessary. Changes that would have taken decades happen in years, not because the system failed, but because it was already stressed. This is how history usually moves. Slowly, then suddenly. None of these futures are destiny. They're branches, and the world will likely drift through pieces of all three, because systems don't choose endings. They respond to pressure. If there's one thing to take away from all of this, it's simple. Oil pricing in dollars is not the foundation of the system. It's a pillar, an important one, a load-bearing one, but not the whole structure. Pull it out and the building doesn't collapse. It leans. Stress redistributes. Cracks appear in places people weren't watching. And for a long time, everything still looks fine. That's how monetary power works. It doesn't disappear in a moment. It erodes quietly. So quietly that people argue it isn't happening at all. Until one day it feels obvious. Not because something dramatic occurred, but because the assumptions stopped working. And by then, the adjustment is already underway. So here's the real question. If the dollar's power depends more on habit than law, more on routine than enforcement, what happens the moment the habit breaks?